everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today, I have a special guest, Christian Spielvogel. For those of you who have followed me all along, Christian is not a stranger. He's been on my YouTube channel for multiple times for a very, very good reason. I'll let Christian to introduce yourself.
Sure. As Cherry said, my name is Christian Spielvogel. I'm the Chief Investment Officer and founder of the Aliferis Group, where we do primarily real estate investing and angel investing in tech firms. And we recently launched an academy for investor training called Aliferis Academy.
Oh, cool. So we all know that there's some big news that just came out with the interest rate cut. So what's your take with this interest rate cut?
Yeah, so interest rates are one of those things that are really important in our business. And because it's one of the biggest expenses that we're actually going to end up carrying.
Yep.
And the thing that I always think about with interest rates is that I can't control what happens. I can't control what happens on the global stage, right? I had no idea that Russia was going to invade Ukraine when it did. You know, I had no idea that, while there was trouble brewing in the Middle East with Israel and Palestine, you never know when that stuff is going to happen.
Yep.
The pandemic, you might have been good at predicting that a pandemic might happen. You'd be hard pressed to say when it was going to happen. So a lot of things happen and then you don't expect it. And so for me, when it comes to dealing with interest rates, is I honestly don't know what's going to happen. I'd say, I often tell people that my ability to predict interest rates is only slightly better than random chance. And as such, I always take a look at interest rates as something that needs to be actively managed from a risk management perspective. So in my case, I have operations, I have staff that I have to pay, et cetera, and we depend very much on the cash flow that's coming out of our business, our real estate business. And therefore, for me, I take a look at fixed rates quite often as a way to mitigate that risk. And I view fixed rates, even though they tend to be a little bit more expensive in some cases, as an insurance premium. And so what I do know when I take on a fixed rate is that I have absolute predictability over the next 5 years or 10 years or whatever horizon that I'm working to. So while I'm optimistic that short-term rates may come down, long-term rates may come down a little bit as well, but ultimately we'll see that yield curve kind of go back to normal. And if that's the case, then the effect is primarily on variable rates coming down and reducing overall cost. But I always take the attitude of, I don't know what's going to happen next year or in 2 years, so I tend to focus on predictability, and probably about 20% of my portfolio is in some form of variable rate.
Yep. So I remember last time when we chat on YouTube as well, you were talking a little bit about refinancing your property at the time, and you committed to like maybe a 10-year fixed rate mortgage, correct?
That's right. Yeah, I did those about 18 months ago now. And the rates that I got on those with CMHC financing was about 3.85%.
That's really good.
It looks really good, exactly.
Yeah.
And on those properties, because they were largely stabilized, there was relatively little upside left in them at that point. So it meant that I would rather have the stability over 10 years. If I had done it on a 5-year term, I wouldn't have had the same interest rate either, because my debt coverage ratio would have been higher as a test. And the interest rates for the bonds were actually higher for 5-year than they were for 10-year. So the combination of the long-term stability, lower interest rates, higher loan to value on it, and the other part of the risk management on that, of course, is if you have a high loan to value, you need to figure out how you're going to deleverage. So for example, if somebody had like an 85% loan to value before the interest rates started going up, then when interest rates went up, and if you had a maturing loan, your requalification to refinance, particularly on commercial assets, would have had the LTV come down significantly because the debt coverage ratio requirements would have driven it that way. So then you would have to do an equity injection just to get a refinance to happen. And that is a horrible place to be in.
Yes.
So.
Yes, absolutely. So you are telling us that if you were to buy a property today, you're going to commit to fixed rate? Is that what I'm hearing?
I would actually look at some shorter term fixed rates. But again, it depends on a personal circumstance. So historically, variable rates have always been more beneficial, like if you look at it over the long term. So there's nothing wrong with variable rates per se, but you need to be able to manage the fluctuations that happen with a variable rate. And so that's part of risk management. So if you have good reserves and you can handle the ups and downs, right, then you can use your reserves in order to be able to manage that risk, and effectively you're self-insuring. But if you're tight on reserves and you can't really afford to handle the ups and downs, fixed rates can be a good way to insure your cash flow over a period of time. And in the current circumstances, a medium term might make more sense for some people, that are really tight in terms of their reserves.
Yeah, so I have on top of real estate investing, I also last year I bought this business with like 100% financing. And I remember at the time the interest rate was still going up. There was no sign of coming down or stabilize at the time. So I opted in for a 3-year fixed rate term. And I just want some stability because everything else in my life, almost everything else in my life at the time was in variable.
Right.
And it was just like not a good feeling to also enter into this huge, gigantic loan with variable rate. So I opted in for like some form of short-term fixed rate, just so that I could have the certainty this is exactly what I have to pay. I don't have to worry about it.
Yeah, and you have a lot of staff, right? Especially in the acquisition as well. And so the nice thing about having that 3-year fixed is your cash flow is very predictable. It's more dependent just on your revenue growth.
Exactly. So that's the part that I always look into, like diversifying. The mantra these days is diversifying. How do I de-risk, de-leverage certain things in our lives? And I guess, are you still buying? Because you've already owned so many, a portfolio of properties. Are you still in this acquisition mode?
Oh, yeah, absolutely. So I've got a couple of construction projects on the go, right, which are eating a lot of my cash. But other than that, we just acquired a beautiful building earlier this year. And this is actually a really good time to buy. Right? It's
How so? Because I heard that rumor on the street is that buying activities is not there. That may be the reason why.
Yeah, exactly. So people aren't buying. So that means that given that it's been difficult to sell over the last couple of years, at some point people start to really get motivated to sell. They may have other stresses in their life where they're requiring capital. So I bought a beautiful small office building earlier this year. I think you've seen that one actually. It's it's an old post office in Almont. And that's a situation where the seller required capital for other ventures they were doing. And they were effectively a motivated seller. So given it was office, right, which is a toxic asset with the A lenders, and also because there are just not a lot of buyers that would be able to qualify to be able to do this, it became easier to deal with it. I really didn't have any competition on this. The only real competition I had was the seller's ability to do a refinance and take out enough equity to service his other needs. So I needed to be competitive to a refinance situation, but that was about it. So I got a really good deal, and that property cash flows on acquisition. It has some upside on it as well, but I'll be perfectly honest, I bought it mostly for jewelry because it's absolutely gorgeous.
That's how you collect your jewelry as a real estate investor. Buy a historical office building.
Exactly.
Yeah. Oh wow! So other than the office building, so in your office building, like commercial investment portfolio, are you seeing vacancies? What are you seeing around the business office space? Because with the clients that I work with, they are a lot of them are in the nonprofit space in Ottawa specifically, and I know your portfolio is primarily located all across, at least the commercial side in Ottawa. How's that space doing?
So the key to that is making sure that you have what I would call Class A, right? Or prime real estate of some form. So if I had office space that was on a back street in a so-so neighborhood, I would be super nervous and I'd have to discount the heck out of it. But all of the pure commercial stuff, so the retail, the office space, et cetera, are in prime locations. They're on main streets, highly desirable. So for example, I just had a vacancy coming up in July. And I had a queue of 5 retailers wanting that place, and they were willing to pay whatever I was going to charge. So the rent's gone up significantly on that. But it's on a main street in that town, and that makes it desirable. If I had the same size store, but it was, say, on the 2nd street over or 2 streets over, I would be having a tough time. But on the main streets, it's still going very well. And that office building is right in the heart of the, of the district in that particular town. And it is such a beautiful building that people want it to be their office.
So that sounded like to, I guess, de-risk or to mitigate against all your risk, you have to start from the beginning, from acquisition essentially, because you have to buy in the right location to attract all these, even when there is an economic downturn. That location is going to save your butt.
That's right. And what you said was spot on in the sense that it's all about your risk management plan. So right at the beginning, from the acquisition all the way through the process, whether it's the location you're buying or how you're financing it or how you're operating it and running it on a day-to-day basis, you have to have a risk management plan that covers all those potential eventualities. It just allows you to sleep better at night. Right? So sometimes people have a tendency to just buy something because it's cheap, right? And there's a reason it's cheap. So.
Yeah, oh, cool. So I know you're working on this big project of essentially equipping, providing all the knowledge necessary for a new beginner to start investing in real estate. So, but before we get into that project specifically, can you share a little bit about your advice if you were given, or if, say, Adam, a videographer who's like brand new here, coming to you and say, hey, Christian, give me 5 tips on, starting my real estate investment journey.
Right.
So what would you say to a young kid like Adam, who's barely 30? Adam's not showing his face, don't worry. Nobody knows who Adam is.
Well, Adam's actually pretty cool, and I think he's a Formula One fan too, from what you're telling me about his driving. So, but it's one of those things where a lot of people get into real estate because it's a hobby. Somebody said they should just buy something and hold it, and honestly, that's the way I started too. When I first started, it was a retirement plan because I have no pension or had no pension in my corporate career. And I was doing okay with the stock market, but I wasn't going to live a great retirement life. So I realized I had to do something different, and I started collecting real estate like a lot of people do. But I wasn't doing it really very smart. I mean, I was making good decisions, but I wasn't being efficient. And so one of the things that I discovered later is I did take some real estate training and took a variety of courses, etc. And it wasn't so much that those courses taught me really important things, but what they did was open my eyes to what all the possibilities were. And then I became much more efficient. So when I made a transition later on from converting my real estate investment to a hobby, from a hobby to a professional thing, I had all the right tools in order to be able to structure how I was going to do that. So that kind of leads me back to your question, which is the kinds of things that you need to know. And you need to know the team that you need to put together. You need to know how to do proper financial analysis. You need to know, and this is something that's skipped a lot, is how to do proper market analysis and how that market analysis impacts the financial assessment that you're going to make. So that becomes key. And then you need to know how to put together things like a simple set of objectives. What are your goal setting requirements? How to build a risk management plan.
Yeah.
So just like we were talking about earlier, it's pivotal. It's not something that is an afterthought. It's actually core to the way you do things. So those are some of the key things that people need. There's a lot more to it, right? But those are some of the really important things that people need to consider.
So I think working with, I have, as some of you would know, I'm working as a CFO for multiple nonprofit organizations, and that's what my other business does. And looking at what we do as a CFO, we often look at scenario analysis. And what struck me the most with the comment that you just made was the market analysis and how it would affect your financial analysis.
Yeah.
Can you give us an example
Sure.
of that exact market analysis? I can give a gazillion number of examples. It may not be relevant though. So yes, what is your take on that?
Sure. So here's probably a good example, or a couple of good examples, because you kind of need opposing examples.
Yeah, exactly.
So one of the things that we know about the GTA is it's economically diverse, it's very, very stable. And so what you see is that real estate tends to be relatively expensive, right? Cap rates are relatively low because you're paying a premium for that stability. Okay, so that's one side of it. Now, if you go to some place like, I don't know, let's say North Bay, for example, or Kirkland Lake, where it's primarily mining town, etc. In those situations, the economy is very dependent on certain aspects. So in Kirkland Lake, it's dependent on mining. And so your ability to benefit from appreciation is relatively limited. So when you're looking at the financial analysis, you need to take a look at, well, how long do I think this town might be on the map? Okay, and maybe the mine's lifespan is only 10 years. Well, that says you have to make all your returns within that 10-year time frame, which means that it's going to be largely a cash flow play, and that your internal rate of return, or whatever metric you're choosing as your basis for your returns, has to be achieved by 10 years, because the town may not exist, anything can happen. And so then anything that goes beyond that time frame is purely a bonus for you at that point. But if you make that analysis early on, you're going to make the right decisions. And I saw a lot of people, for example, going to some small towns like Smiths Falls or Moncton, etc. And they were buying it because it was cheap. But it may be a good investment depending where you bought, but it also, we needed to take a look at the time horizon as that as well, to make sure you get the returns that you're actually looking for.
Okay, that was a really provoking example there. Another example that I could see, even as simple as really stress testing your financial numbers. The one thing that I think a lot of people are really looking at is the best case scenario all the time. Because that's often what's being given to them when they decide to buy, because that's what's given in the listing as well, the best case scenario. I think a lot of people may not really do just something scenario analysis and stress test if the interest rate go up to a certain point, or even if the property management goes up. Like right now, property tax has gone up substantially all across Ontario, I think all across Canada in general, because our governments are generally broke, regardless where you are. So all these things have to be essentially put into that calculation.
That's right, and that's the basis of a risk management plan. And I remember my very first acquisition. We were a single income family, and what I was worried about is I was going to do this acquisition, and I was worried about what happens if it goes cash flow negative, and could I sustain it, right? I didn't want it to impact my family at all. So I spent a week analyzing this thing to death on Excel spreadsheets, and it was exactly the kinds of things you were talking about. It was like, what happens if interest rates go up? What happens if I have vacancies for extended periods of time? What happens if I have non-paying tenants? What happens if I have an unexpected capital expense, such as a roof or a boiler going all of a sudden?
Yeah.
And so I put that all in a spreadsheet, and I managed the upside and the downside, and I could kind of figure out through my worst case scenarios how much it would impact me, to the point where I was like, okay, based on that, I knew what my maximum price that I was going to offer would be, so that it would help manage that overall risk. And then it ended up helping me in the negotiations for two reasons. One is, obviously I knew what my maximum price was going to be. But then I could also talk about my concerns with the seller. And the seller was a very experienced real estate investor and a sweetheart of a guy. And he basically said, for example, on the vacancy rate or vacancy issue, I said, well, I'm worried about the vacancy. Again, we're a single income family. And he says, well, I'll guarantee the rents for a year.
Oh, wow.
How's that? And I said, okay, that solves that problem.
Oh, that was nice. That wasn't even a negotiation. You just bring up the concern that you have.
That's right. So, but for him, by offering that, he removes a risk off the table, which means that he's hoping that I can move on my price a bit. And that's all part of the negotiation. But it's by having that information, it was a very informed negotiation where you're trading a discussion with the other person in a way that makes logical sense, as opposed to an emotional buy. Some people say, that's my price, and if I don't get it, I'm going to walk away. I don't find that to be a very successful tactic, personally.
Well, you're also looking at like a bigger project right now, right? Like you're looking at multiplex as well. So it's a very different, I would say very different negotiation tactics when it comes down to pricing compared to your triplex, duplex negotiation, right?
Absolutely.
Yeah, so those are really great information. Do you have those Excel workbook available in your academy?
Oh, we do actually have things like goal setting templates. We have a risk management spreadsheet that will help, and the resources and the videos that go with it to show you exactly how to use them properly. There's offer templates as well, so that you can see common clauses that you should have included in your offer. So it enables you to have that discussion with a realtor. And most importantly is there's lots of detail in each of these lessons to not just tell you the 50,000 foot view of how this is working. That's, there's a lot of that out there, and you can probably get that off of YouTube type stuff. And but it gets into the nitty gritty as well to explain exactly step by step. So, for example, in financial analysis, which is a lot of what a lot of people need to understand, is what are the metrics? How do you use them? How do they relate to each other? And how do you use that as a basis for assessing whether a property is a good acquisition or not? How do you put a business case together? How do you do pro formas? For market analysis, it gets into the nitty-gritty detail of how to properly analyze a market so that you understand exactly what's happening in that market to a point where you can converse with somebody else in terms of the realities of that market, and it sets your foundations properly for how you do your financial analysis. So it goes into a significant amount of detail on that.
So you are, so anyone can, anyone that's watching this and they are interested in real estate investing in Canada would be able to subscribe to that? Like where can they find out more?
Yeah, so it's called Aliferous Academy, and for me, this is a passion project. It's not a profit type thing. So we have to charge enough in order to be able to do the marketing and sales and compensate the instructors. But I'm not personally. I've got enough money for my real estate stuff, so I'm not really trying to make money out of this. I just want to make sure that I educate people in the best possible way. So the way that it's structured is that it's really good detail for people to be able to use, and it's taught by people who are active in the business. They're not professional coaches. They're not professional instructors that may have done investment at some point in their life. They're people like you, for example, who are absolute experts in their field that are giving information for people to be able to use. And that's really the mantra. So I kind of think of it as like the master class of real estate, where it's experts teaching you the topics, whether it's private lending, whether it's foundational stuff on learning, whether it's accounting principles in Canada, etc. So.
Okay, cool. That's really, really interesting. So if they want to find out more, they can go to the link shown on the screen and also in the part of the YouTube notes as well.
Yeah, perfect.
Okay, one last thing. I'm going to end our interview with one last thing.
Sure.
So if is there some word of wisdom after how many years have you been investing? Many years.
Oh boy, I'm just coming up to 20 years of investing specifically in real estate.
Yes,
yeah.
So 20 years, right? So 20 years of wisdom, what's the word of wisdom to Adam? I mean, not Adam specifically, Adam as the new guy on the block that wants to invest in real estate.
I would say that it's really important to be educated, okay, to learn. And whether you're, taking a course from us or whether you're hiring a private coach to, to work through everything, it's not that you can't learn this stuff on your own through other sources. The issue is speed. Okay, in the real estate business, time is your friend, right? But it can be your enemy if you take too long because you're missing. It's just lost opportunity that's gone. So hiring a coach or taking education really allows you to accelerate very quickly, and so realizing your ultimate goal, whether it's a retirement plan, etc., gets realized faster and more efficiently.
Well, that's amazing. Thank you so much. I want to thank you from the bottom of Adam's heart. Thank you for sharing all these. For anyone who's interested in signing up with Oliver's Academy, it's only $158 a month, and the link is in the show notes below as well as on screen. Thank you again for coming on, and I'm sure we'll have you again very soon.
Thank you very much for having me.
Yep. Bye.